Hello, and welcome to the Wealth Consulting Group's 2022 Market Outlook. Today, we'll be walking through a year in review of 2021, as well as our outlook for all of next year. So 2021 we had a remarkable year of asset appreciation, and this was largely due to easy monetary and fiscal stimulus policies that started in the year 2020 and continued well into 2021. We are seeing an end to this in terms of monetary stimulus. Eventually, we'll see an end to this in terms of fiscal stimulus as well. We've seen extended economic recovery from 2020. And looking at the US monetary base, we've added roughly $3 trillion, not quite $3 trillion, but this is how much the monetary base has expanded. This is what the Federal Reserve has done through their asset purchases. Now, we do know that they're tapering this program. We also know that initially in 2020, they were buying some ETFs. That has stopped as well. When we look at what this has done for the economy and for the stock market, this has extended the economic recovery and has provided strong economic growth. You can see here the large drawdown that we had in economic growth due to the pandemic, but we've recovered in many areas strongly, and profit margins are near all-time highs. This is at 12%. We see that S&P 500 earnings growth is also very, very high. When we look at this, those earnings really started increasing and kicking in the year 2021. We believe that going forward, this is going to be not as strong in 2022. But we've also had a disjointed labor market. This has been a strange environment where all this liquidity going into assets, as well as fiscally, we've had large stimuluses. We've had unemployment benefits that were much higher than normal. This has created a disjointed labor market, along with what COVID has done. Areas that were shut down, some of them took a while to reopen. And there were some individuals that were concerned about safety. Some individuals were not able to work from home. And so this has created a very disjointed labor market. When we look at the labor force participation rate, we have recovered some, but we're still quite a ways off where we were prior to the pandemic. This is interesting to see that we've had more than 4 million people quit their jobs in the month of November. And at the same time, there have been 11 million job openings. So there's still largely a big disconnect in terms of the number of jobs available and those willing to take those jobs. This has created some bottlenecks. We've already had supply chain issues due to the pandemic and shortages, but there's been shortages with the labor market, and all of these things have added to high inflation, the highest inflation we've seen in several decades. Commodity prices have added to this high inflation. This is the Bloomberg Commodities Index. This, has gone from index level of roughly 60 to 105 and now down to 95. This has certainly added to some inflationary pressures. Oil prices that for a period had negative futures of negative $40 a barrel. That has recovered well. Right now, these prices are closer to 80 as of today. But when I did this chart, it was roughly $68. So this has added to inflationary pressures. And average hourly earnings, this is the stickier side of inflation that looks at earnings increases. And as you can see here in this chart, typically we see increases of 2 to 3% per year. And we've had a spike that was over 8%, then it went back down almost to zero, then it came back up and it's right around 5%. So this is still going to add to inflation. One of the things that all this liquidity has done is it has also created uneven asset appreciation. We know that a rising tide lifts all boats, as the saying goes, and we certainly saw that, but we saw that some asset classes performed much better than others. This COVID has created kind of a tale of two different markets. One market that is a stay-at-home market where those companies that benefit from COVID, be they pharmaceutical companies, biotechnology companies, or your exercise equipment, your Zoom types of companies that tend to do well with shutdowns. These performed well during the pandemic, then they sold off, and then they performed well again during concerns over the Delta variant. And so we've had this back and forth. Also with interest rates moving higher and lower, we've seen financials, energy, more cyclical industrial companies do well when rates are moving higher, and those not do well when rates have gone down. But your higher valued technology companies that are larger have done well when rates have gone down. And that is largely due to the very, very long duration of large tech companies. As we look at US equities, here's a picture of where we're at with all the different US indices. We've seen that the NASDAQ composite, which is the CCMP in Bloomberg, this has actually outperformed everything over the last 2 years, although the last 1 year it has not performed as well as the S&P 500. We can see here the Russell 2000, which is the orange line, has been largely flat for much of 2021. And when we look at international equities, there's been an even bigger disconnect. You see that the US stock market, as the S&P 500, has done very, very well compared to some of the other developed and emerging market countries out there. You see the dark purple line as the Hang Seng has struggled. This has been different impact with different countries and how they're dealing with COVID and how their markets are doing. We can also see that speculative money with all this liquidity has created pockets of speculation and bubbles. Things like Bitcoin went from $10,000 all the way up to $60,000, then back down to $30,000, and then all the way up almost to $70,000, and then back down to $45,000. And then things like GameStop and AMC, there's been some meme stocks that have done well during this kind of, part of the stay-at-home period. But these things have gone up and down. So that certainly has been an interesting environment. The U.S. 10-year Treasury is something that we look at very closely here. We see that this got down to roughly 50 basis points during the midst of the pandemic, and that quickly came back up to 1.5%, and even got as high as 1.7%. But it's kind of bounced around whenever there seems to be some concerns of a new variant that has gone down. And with that, we've seen assets behave differently, whether that's gone up or down, different stocks. Here we can see the correlation between value stocks and rates. When rates have moved higher, we've seen value do well. When rates have gone lower, value has not done as well. We also see a correlation here with small cap stocks and rates, that when rates have gone down, small caps have not done as well. When they've gone up, they've done better. There does seem to be a correlation with not just the movement in rates, but a steepening yield curve tends to benefit the smaller cap companies more so than the large cap companies. And so our outlook for 2022, first of all, we don't believe that all inflation will be sticky. meaning that it's here for good. There's been a lot of talk this year about transitory. What does transitory mean? It's a nice fancy word for temporary, but what does temporary mean? Does that mean weeks, months? Does it mean quarters or years? Well, in some cases, that could be years in terms of microchips that go into cars, things like that. Those bottlenecks will take a while to get resolved. We've also heard about shortages with lumber and lumber prices going up and then coming back down, then going back up again. So some of these things are going to take a little bit longer, although commodity prices will be a little bit quicker to react. So those are not going to be as sticky to the extent that things slow down, growth slows down. We believe that will also slow down some inflationary pressures, particularly with commodities. To the extent that labor markets are still have that disjointedness, we believe that that is going to create more sticky inflation that stays with us for a little bit longer. To the extent that there's more job openings and more demand for jobs and labor shortages, that's going to add more to inflation than commodities would. We believe the Fed is going to stay its course. They're going to continue the taper, and it looks like they're going to be raising rates most likely 3 times next year and then 4 times going into 2023. What would change that is the data. They are going to be data dependent. And so if they see some recessionary pressures on the horizon, they will look to adjust and adapt. We believe that we're still going to have this the tale of two markets where different asset classes are going to perform differently. That's going to give us lower correlations, which is a good thing. That helps with diversifiers. And this also helps for those that are tilting more toward those things that would benefit with a reflationary environment. We would expect, though, that this year would be subdued relative to 2021. The price that we'll probably see, price appreciation that we'll see with the markets is probably going to be in the neighborhood of 8 to 10%, maybe higher than that if earnings turn out to be better. We've had roughly 50% growth in earnings is the estimate through this year end. Those numbers, we won't see those numbers likely until later in January, early February, but that's a very, very strong year for earnings. We've also had a lot of multiple expansion. We don't see that multiples will expand much from where they are today. We also see that earnings will likely grow in the neighborhood of 10 to 15% for 2022. So we expect volatility to be very binary, which means that this is going to be a risk off, risk on environment to the degree that uncertainty is waning and we see that things are kind of getting back to normal. We believe volatility will come down, but there may be pockets of periods where there's some uncertainty over COVID or uncertainty over geopolitical tensions that could cause volatility to spike at certain times during 2022. So earnings, as I said, we believe those will slow in aggregate if we look at the whole market, although we believe that the earnings growth is going to be strongest for those smaller companies as well as for those more value companies. A lot of these companies are going to be cyclical companies. We still like energy and we still like financials. We believe the trade in energy is a shorter term trade, especially if we see higher oil prices too soon. If we get to $100 a barrel or higher, that could create some demand destruction in terms of consumers wanting to not spend as much or not travel as much. So we'll have to see that dynamic play out. With banks and financials, insurance companies, we see this as a longer term trade. A lot of these companies are trading at very good valuations, and they're just starting to really grow their earnings. And as rates move higher, that's going to help them even more. The best case scenario for 2022 is we have this sort of globalized, global synchronized reboot. And, this is going to help some of the disjointed supply chain issues. That's going to smooth those out. At the same time, that's going to be inflationary to the degree that, these other economies are opening up more. The whole global system is functioning better. Trade is functioning better. And that will help iron out some of the issues that we have with supply chain and supply demand mismatches. It will likely be inflationary. That would be more of a transitory inflationary type of environment where it would elevate commodity prices higher, but that is not going to be sustained for years to come. That would be more temporary. But the important thing to take out of that is that this is going to help growth. While it would be pushing inflation higher, it would be pushing growth much higher too. As we look at the current yield curve, we can see that we've had a little bit of a twist in the yield curve, with the longer term rates actually coming down and shorter term rates, with the exception of the 1 month and the 3-month treasuries. We've had rates move down for the longer maturities and rates move up. And so this is kind of a twist or a slight flattening, you could say, of the yield curve. Although we believe that we're going to see more of a shift in the yield curve, with rates moving higher across the board, potentially moving higher for longer term rates. This is going to be an area of concern for those that own high quality bonds that go out to 10 or more years of maturity. When we look at profit growth here, this is from the S&P Global, all earnings that are actual as reported earnings, as well as estimates from sell-side analysts. We can see here that there's been very, very good growth for 2021. But as you can see, that orange line there, everything to the right there is expectations for 2022. It looks like we're going to see 10 to 15, maybe 15% earnings growth, maybe earnings come in better, but this is kind of what it currently looks like. And as I mentioned before, multiples will not likely expand as they did in 2021. Now, as we look at high yield spreads, things are still very, very tight here. When we look at almost every asset class, you could say that everything is overvalued, but it is good to see spreads lower. Financial conditions are still good. We'll keep an eye on this if we see things move higher, and if there's some concerns of upcoming downgrades or credit issues, we will certainly keep you informed of that. But for now, high yield spreads are low. That makes high yield bonds more expensive. Stocks are expensive, but relative to high quality bonds, we believe that stocks are still attractive. And this is one way of kind of looking at that, the yield on the S&P 500. This is not the earnings yield. This is the dividend yield. Still almost the same as what the U.S. Treasury can give you. Now, the key difference here is you buy the S&P 500, not only are you getting the dividend, but you're getting a lot of future earnings growth. And there is some inflation protection by owning stocks relative to owning something like a long U.S. Treasury, where there's no growth priced into that. It's all yield. And then as rates move higher, there's that duration risk that you can lose some money when rates move higher. Some risks to the outlook that we have here. And this is probably an order of things that are less likely and more likely. Omicron or other COVID variants. This is an ongoing concern, but I believe this concern is getting smaller. There's a lot of work that's gone into vaccines. A lot of the globe has been vaccinated, and the vaccines seem to be working, even with these new variants. But there still is a risk that there's another variant that the vaccines don't work very effectively against. And to the extent that those New variants are extremely deadly and spread extremely fast. That can be a problem. That is a risk to the outlook, and that can cause a lot of uncertainty with the markets. Another concern that's difficult to model here is just geopolitical stress when looking at China and Russia. Does Russia invade Ukraine? Does China invade Taiwan? So these are things that would create some uncertainty and create some risks. Another thing that we're looking at is, does the market continue its great run? We still have a lot of liquidity in the market. Does that push the market higher than it should by a lot? And if that happens, we could see a melt up and then a melt down in the market. So we certainly don't want to see that. Probably the most likely scenario here is this last one. The risk is a Fed policy mistake. Is the Fed doing too little, too late? Or if they're too quick, if economic growth starts slowing, and if they're too fast to tighten, this is going to be a risk on both sides, a Fed policy mistake. So that leads us to this next slide, which I love to review with advisors and clients. This is a very long-term look at the S&P 500. This is total returns and a regression line going all the way back to 1929. And as we see here, the market has generally followed a very good trend line in terms of where it's gone. There's only been a few times where it's been extremely overvalued or extremely undervalued. We see that, recently we saw that the market was 2 standard deviations below the mean, and that was in the financial crisis. And in the year 2000, the market was 2 standard deviations above the mean. But right now, we're not quite 1 standard deviation above the mean. We're still closer to trend line growth. So if you're a long-term investor, or if you have long-term investors that you're advising on, this is a good long-term focus of the market and where we're at and what the risks are. Sometimes we get a little bit too focused on the bumpy road ahead of us and not so much on the long highway that is generally a smooth ride. And here's the last slide that looks at disclosures. Please read over. And I hope you all have a wonderful new year. And we look forward to speaking with each of you. Have a wonderful 2022. Thank you.